unless you've been living under a rock, you're watching the markets right now and you're just like, oh my gosh, why is this thing crashing every single day? I mean, if we look at the S&P 500, it's almost in correction territory, which just means that it's almost down 10% or more. We look at the NASDAQ, that is fully in the correction territory when we do a year-to-date comparison at down almost 16%. And your question is like, what is going on? What is causing the markets to just continue to go further and further and further down? Well, I would like to introduce you to somebody. His name is Jerome Powell. He is the chairman of the Federal Reserve. Yeah, this guy. He is the reason you can basically he is part of the reason why the stock market is going down, because of something that the Federal Reserve has control over. Remember, the Federal Reserve controls our monetary policy, which means they control interest rates and they try to play around and make sure that we have strong employment in the economy. And so recently, you've probably seen the headlines of like, oh, interest rates are going up. The Fed is going to increase your interest rate. The Fed announced that interest rate might increase in March. And you're asking yourself, how does that affect the stock market? Why should interest rates play a role in the stock market? Well, in this video, that's exactly what we're going to break down. I'm going to break down exactly how the Fed funds rate, which is the Federal Reserve's interest rate, affects the entire economy, and also how that plays a role with how people choose to invest and how that affects the stock market. So if you're ready for it, let's get this thing started. What's going on, people? It's your boy Kalechi back with another video. If this is your first time around these parts, hit that like button. If you enjoy anything that we talk about on this video, hit that subscribe button, all right? But anyway, like I said, we're going to be talking about how the Fed funds rate affects the economy as a whole. And before we get started, let me just give you a quick definition of what the Fed funds rate is. According to Investopedia, my favorite investing website to do any kind of understanding, it says the term Fed funds rate refers to the target interest rate set by the Federal Open Market Committee, FOMC. This target is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. The FOMC, which is the policymaking body of the Federal Reserve System, meets 8 times a year to set the target federal funds rate, which is part of its monetary policy, the thing that I mentioned a second ago. This is used to help promote economic growth in different ways. So this is key to how we run this economy. Like, the United States is built on credit. So interest rate is very important. But to help you understand why that is key, I made a little bit of a PowerPoint to help explain this whole thing. Right now, we have the Fed funds rate at 0.025%. This is where it is right now, which is essentially zero. So it means that when banks are trying to lend to one another, they're lending it at 0% interest rate. They're not really making much of anything on it. So when somebody like me, let's say I, with my Rambling Mind podcast, which by the way, you should go check out. If I decide, you know what, I want to invest money and this podcast has been doing pretty well, I want to actually go get a studio now so that when I have guests, I have a place that they can go to rather than trying to figure out how to fit them in this tiny little room. I can have guests, take them to the studio. We can chop it up, do whatever it is that we need to do at the studio. But I also want somebody to be monitoring all the sounds and everything. So it means I have to rent out a space, but also I have to also pay for somebody to monitor everything. So I need to be making money that way. However, your boy ain't got dinero to be able to make this investment. I ain't got no money. So what do you do when you're trying to start a business idea and you ain't got no money? We go to the bank. So I go to my local bank. I have a good relationship with my local bank. I have a banker over there. I go over there. I'm like, yo, bro, I need some money. Okay, I need some money so I can invest in this new endeavor that I have going on. You guys have all my credit information. You know I've been good to y'all. Y'all have been good to me. Please help me out. And being that he wants me to be a happy customer, he's like, yeah, you know what? Let me go check some things out. So he goes back. He talks to his manager. His manager says, hey, just so you know, we ain't got no money either. So we got to go learn some money. We got to go get some money from a bigger bank. A big commercial bank like JP Morgan, for example. So they go over to JP Morgan and say, hey, yo, we need some money in order to loan some money out so we can get some money off of that, right? And so they go to JP Morgan. JP Morgan, remember, it lends money overnight to all kinds of different banks all the time at that 0.25% interest rate. So at this point, JP Morgan is like, yo, we've borrowed money from the Federal Reserve. We've borrowed money from the government. In order for us to be okay, we need to make some profit off of that. So JP Morgan lends the money to the local bank at about 1%. They're like, yo, we need to make some credit off of this thing. So they make about 0.75% off of this. So they lend it to you and you're like, cool, thank you very much. Then they come back to me and they're like, yo, this is what we can do for you. We'll give you an interest rate of about 3%. Are you cool with that? And he's like, you know what? That's not too bad, right? It's like 3% interest rate. That's not bad. I can take that on. I believe that my venture will give me about a 10% return when I do this. So you know what? I'm going to go with it. So everybody's happy. So the spread on this is about 2% for the local bank. They're happy. And then the spread on it for JP Morgan is about 1%. They're happy as well. So everybody's smiling. I got my money. I can go ahead and start my studio and do what I need to do for my studio. Local bank, they're happy too. They got their money. They made a little spread. They can help the community out. You know, they have little shareholders, whoever owns the bank, whatever. They're happy too. Of course, the big banks are happy. When they make that miniature spread, they're talking about billions of dollars, baby. So, you know, all their investors are happy. They're like, yo, thank you for doing that deal. But now let's talk about another situation where the Fed funds rate is at about 4%. Now everything changes. It's still the same situation. I'm still trying to build out this business. I have the same idea. I need to get this podcast studio. I need to hire some people to do some stuff for me. I still don't have any money. So, you know, situation hasn't changed. All that has changed is the 4% interest rate. I still have great credit. The bank still loves me. So guess what I do? I go to my local banker in this situation and I say, yo, man, I'm back. Need some money. Can you hook it up? Local banker says, hold up. Let me go check some stuff. So he goes to the bank. He says, we ain't got some money. They say, let's go to JP Morgan. JP Morgan can hook us up. They go to JP Morgan. JP Morgan looks at him and says, yo, right now interest rates flowing between me and other banks is about 4%. I need to make a spread on this. So they try, we're going to give you this money at 5%. The bank says, cool. We're going to go to our customer before we take this money and talk to him because we're going to have to charge him 7% in order for us to make our spread again. All of a sudden, the whole situation has changed. Remember, for me to be profitable in this business venture, I'm only making 10% on the return. And so the question I have to start asking myself is like, hold up, I got to pay people. I got to pay for the studio space. Can I do that? Remember, the bank still has to make their 2% and 1%. So I have to start calculating, is this 3% enough for me to survive on? Like without me paying anybody? And I sit down, I'm like, you know what? It's not good enough for me. I'm going to go home. So now all of a sudden everybody's mad. I'm sad because I can't do my business. I can't do this business opportunity. The local bank, they're mad because they didn't get some money to do whatever it is that they do at local banks. And of course the big banks, they big mad. They're like, yo, that's money we could have made that we just lost like that. And that's how it works in the economy when the Fed plays around with interest rates. All they're doing is they're playing on different things in the economy. And we didn't even talk about mortgage rates, how that affects the economy as well. Because when the Fed increases their interest rate, everybody else is like, yo, we can go up a little bit higher too, because we got to make some spread on this thing. It affects your credit card bill. It affects your auto loan. It affects basically every single thing because here in the United States, we are a credit-based society. In order for us to grow the economy, everything is based off of credit. It's not a society where everybody uses cash. Everything is based off of credit. And so how does this affect investing as well? When we look at investments, we think about two things, risk and reward. Every single time somebody is saying, I want to invest my money, we are always thinking about risk and reward. But the thing when it comes to risk and reward is a lot of people think risk and reward is a 1-to-1 ratio. In other words, the more risk I take, the more return I'm going to get. But that's not actually true. We all think like, yo, if I just keep investing in more riskier and riskier and riskier and riskier asset, I'm going to make more money. But that's not necessarily true. Ask anybody who just lost a bunch of money on crypto right now. The fact is the curve is more like this. Where the more risk you have, there's a potential you might make some more reward, but that is not guaranteed. It's not guaranteed. Just because you're taking more risk doesn't mean that you're going to get more reward for taking that risk. And so what happens is when the Fed changes their interest rate, all risk dynamics change. So for example, in this graph, you see the money market government treasury funds yield right there. There are two ways that you make money with investments. One, you make money by getting some money back, whether it's in the form of dividends or in the form of regular bond payments or capital appreciation, the one that everybody likes to talk about. I made 1,000% on my investment and all this other stuff. So those are two ways that you can make money on your investment. Either you're getting paid regularly or you're just seeing capital gain and appreciation happen over time. And so that's the lowest one because the faith of the United States government makes it, the United States has never defaulted on a loan. And so everybody's like, yo, that's the safest thing we can put our money in, because we know that at the very least, the United States is going to give us our money back. So with that being said, it means that you're not going to get a whole lot of return from these usually. But in this case, where interest rates are basically zero right now, the 10-year treasury right now is given an interest rate of about 1.8%, which means that for every $100 you invest, you're getting $1.80 back. That's not a good return. That's not great. That's not what people are trying to look for in this market, which means that all of a sudden, your risk reward and risk reward appetite completely changes. It means that when they look at it, they're like, yo, that's not good enough for me. You go further on the risk appetite. So you go to investment grade bonds. You look at bonds that give it maybe like 3 to 4%. It's like, yo, that's like saving accounts money. Like, we don't want that. You keep on going. That's why we saw in 2020 and 2021, so much money flooded into stocks, because that was the only thing that seemed to be giving good returns. But over time, as things got more and more expensive, people were looking for more and more returns. They got from stocks. They went into small cap stocks. And then from there, they went into even more very risky assets like junk bonds. And then from there, they went even to more risky things like crypto. And it's just more and more and more. People are looking for returns anywhere they can get it. And they keep chasing after that, pushing your risk further and further and further out for no real guarantee that you're actually going to make more money. That is why the interest rates matter. That is why when the Fed decides, yo, we're changing interest rates, we're bringing it up, it changes the whole risk dynamic. All of a sudden, the things that weren't as appealing to the eyes, all of a sudden become more appealing. It becomes more appealing to hold bonds. It becomes more appealing to hold the treasury. It becomes more appealing to hold all of these things that, like, with a low interest rate, I don't want to be anywhere near them because they ain't giving me no money. But all of a sudden now, risk is being removed from the market. Everybody's like, yo, give me my money back. I can put it somewhere else and not have to worry about it as much. This is why it's important for us to pay attention to the interest rate. However, what can you and I do about this? How can we use this in our investing? The truth is, you can't. If you're a long-term investor and you're thinking out 5, 10, 20 years down the road, you shouldn't worry about this too much, because the interest rate is forever fluctuating and forever changing. If we look back to the early 2000s, we had interest rates closer to 4% from the Fed. 4% today, it's at 0. Which means that more than likely in the future, it will be much higher. The only thing we can do is to continually invest in good businesses that don't depend on the fluctuation of all the macro events that are going on around us. We focus on businesses that have a moat. We focus on businesses with good managers. We focus on businesses that produce cash flows. And if we keep doing this and we buy them as a reasonable price that gives us a margin of safety, we will be fine. And for all my people who are passive investors out there, you shouldn't even worry about this, because you are focused for 30 years down the road. You're just basically like, I'm investing for retirement. I'm 20 something years old. I'm going to retire when I'm 60 something years old. I don't care. I don't know what the future is going to look like. I'm going to just keep dollar cost averaging. You just keep investing over time. You just keep on going with it. We don't know what interest rates might do, so why bother with it that much? It's interesting to talk about. It is fun to talk about. It's good to understand how the economy works. It's good to understand how things work, but you don't let that cloud your judgment when it comes to investing. But anyway, that is all I got for y'all in this video. This was a little bit of a different one. I went back in my teacher bag and brought it out and was like, yo, I kind of want to give a PowerPoint presentation in this one. But anyway, I hope y'all enjoyed it. I hope y'all learned one, maybe 2 things out of this entire thing. And if you did, hit that like button. If you loved it, hit the subscribe button. But I'm going to catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace. Whoosh.